Good afternoon, everybody, and welcome to the FX Week Ahead. It's live market analysis with myself, Giles Cochran. We're going to be looking at what's coming up for this week. We're well and truly underway. The markets are in a really interesting point. So we've got some interesting topics to discuss and to think about during this coming webinar. Just before we get going, first of all, Happy New Year to everyone. I hope you had a good break and looking forward to 2019. And before we get going, could you just let me know in the questions if you can hear me okay, or we just like that reassurance that I can be heard. I think everything's okay my end. Let's just see who's here. Okay, welcome back, Emily. Hi, Joseph. Hi, Ravi, Sol, Susan. Good to have you. If someone could just type in the question or the chat panel just to let me know that you can hear me okay, that would be super. Oh, thank you, Manu. Yeah, thanks, Emily. Oh, that's great. Thank you very much. Good. Well, here we are, the next week, and we are at such an interesting point in the market at the moment. There's a number of different sort of factors that are all interrelating. We're going to be going through these as we begin and look at the individual events. We just need to get the context of the market right now, and you'll see by the end of it why we are at such a fascinating point. We have developments between the US and China trade war. That seems to be thawing. We've got an interesting situation out of the Federal Reserve. We have Brexit negotiations. We have a slowdown in European growth. We've had a profit warning from Apple, which has really freaked out the market. So we're going to be covering most of these things as we go through and trying to plot a safe way through quite an interesting time. So as we look ahead, the first thing to look at is last week you may have noticed some quite strong Japanese yen buying. Now remember, before we look ahead, we need to look back, and particularly when we're coming back to the markets after a break, maybe you've been with family and friends and you haven't been on top of the market as much as you were before. That's really important to just take a bit of time to re-engage and to get that narrative. Remember, understanding the market is like understanding a book. You need to know the characters, the story, the plot, because what we're always trying to look at as currency analysts is a change of the narrative, something that's unexpected, an alteration. So in order to recognize an alteration, you have to know what the norm is. You have to know what the expected path is in order to recognize when there's a deviation from that expected path. So think of understanding the FX markets like understanding a book or your favorite TV program, or even understanding a different person. You need to know, what are they like? What are they not like? If you love someone, you'll know the things that you can do to irritate them, and the things that you can do to make them happy, and you'll be able to read their moods. And in a sense, the market is going to help us to see the market as that person, to get that idea of an emotional reaction. And of course, the market is very emotional because it's simply a reflection of all the market participants that work within it. And even the computers that work are simply programmed by humans themselves. And that, of course, brings us very nicely to this very large Japanese yen buying that happened. Now, this happened after hours, just when the new year started, and it happened at a really vulnerable time for the market, which is after the US Open and before. And what's interesting here is when this happened, the Japanese markets were on holiday. So it's what's known as a liquid market. In other words, there's not many orders. And because there's not many orders in the market, it means that the market can move very rapidly. And you can see this very rapid move. It was called a flash crash. And it's essentially one of the vulnerabilities of the FX markets is this illiquid market. You get it often on a Sunday open. You might see these very quick moves up and down, and you see it in this kind of scenario. This is like a once in a 4 or 5 years kind of time event. Big moves, and I'm just going to go through what triggered this strong yen buying. Now, if we go back to our keynote, we'll see here. Look, basically, this has been struggling. The big picture here is the concern about China's slowing activity. You know, the US-China trade war rhetoric that's been going on for a number of months now. And the concern is that if China slows down, that's going to equate into a global slowdown. Okay, so that's the big concern. Okay, and there has been, you can see from here, from June, July, August, you can see that there's been a flurry of weak manufacturing PMIs out of China. You can see, look, each of them are falling, falling, falling. There is a trend that is down. And basically, manufacturers in general are suffering from fewer orders from domestic markets in China and fewer orders from foreign markets. Okay, that's been the big concern. That's been in the market's mind. Okay, people like myself have been reporting on this for some time, looking at this. If you've been following these HYCM's FX week aheads and the training on the Tuesday, you would have seen this information before. And what really triggered that flash crash was kind of the intensity of this concern here. Okay, so remember, this was in the market's mind, but then Apple, they shocked the markets with news that its sales have been slowing, and they specifically pinpointed economic weakness in China. Okay, that was their specific reason. Yeah, okay, that's great. I'll just type the answer into that question. Remember, don't feel free to answer, just answering a question, and I'll get back to it there. Right, there we go. That's great. Yeah, and so Apple have really kind of exposed this. Their revenue was expected to be is expected to be 84 billion, okay, for the 3 months to 29th of December, and that is versus the 89 billion predicted. So it's a slide in Apple's revenue, and they pinpointed their Chinese market sector, and they're basically saying that it's not doing very well. Now, the iPhone, you know how much people like iPhones. It's seen as a kind of a good indicator of consumer behavior. So a fall in iPhone sales is an indication of a fall in consumer spending, which is going to be weighing on the Chinese economy. Less orders, less people spending, you get the idea. So that's what prompted this very fast crash, which you can see here, and you can see the Australian. Yeah, again, remember, as you've been learning, as you've been following this, the Australian economy is often what happens with China affects the Australian economy because of the high percentage of Australian GDP that is generated from trade with China. So if something affects China, it's going to affect the Australian dollar. And you can see here the Australian dollar fell against the Japanese yen almost over 7% in about 3 or 4 minutes. So there we can see these crashes often happen very quick and very fast. And just goes to show you that, you know, this is why you always use a stop loss, because especially out of market hours, once the US or the Asian session, in this situation, that was the Asian session was on holiday. So a very illiquid market. So always use stop losses. And that's just a good example why you must always do that. So going back to Apple's scenario. Now, it's just worth saying, just to kind of have some balance to this, that Apple's losing ground in China anyway. Okay, so their smartphone share has dropped. So if you look here, you can see that Huawei has got an increasing mobile phone share in China. And, you know, you got to see that Apple, their last big technological development of a handset was the iPhone 8. So they're struggling to bring out something new, and folks like Huawei are bringing out you know, phones with the same features, but for, you know, 1/6, 1/7 of the price. So you can see, okay, there's, you know, there's two sides to the argument. It's just worth being aware of that as well. That's why perhaps it's not as negative as negative as it might be perceived, but you've got to make your own judgment on that. I just wanted to present that to you because, as many of you will know, you know, if you follow mobile phone markets, you'll see that Apple, they've been trying to diversify away from the iPhone for some time, and phones like companies like Huawei are rapidly catching up, and consumers aren't, there's only so much loyalty will get you with when you think, if I can get the same phone for the same features for 1/5 of the price, then consumers will start to move more, and that's what's been happening in China. Now, the other big information out of last week was the December US jobs. Now, this was a very, very good number. You can see that it's 312,000 jobs versus 184,000 expected. The prior was 155,000, strongest since February 2018. The unemployment rate was up to 3.9% versus 3.7%. But the good news about this figure is that was because more people were entering the employment pool. You see the participation rate is 63.1% versus 62.9% expected. So in other words, more people are participating and are entering the labour market. So that's good news. That explains that unemployment rate. And I think one of the reasons for that is retirees have been accredited to entering back into the US labour market. Average hourly earnings up. So average hourly earnings up year on year plus 3.2%. And weekly hours are as expected. So, there's more jobs for more pay and more participation rate. So really, really good jobs number. It takes the average to about 220,000 jobs added to the US economy, month on month average. And that's up from about I think it was about 180,000 addition in 2017. So we've seen a sort of 40,000 net increase in jobs to the US market. So that did, that saw a surge in the US dollar when those figures were released. Okay, so if we just go to the pound US dollar pair, you can just see that when that data was released, there was a surge in US dollar strength. And I was trading the pound US dollar pair at the time, and when I saw those really good job numbers, I traded down to this pivot point here, and then you see a strong reversal bar there, and I'm going to explain what that strong reversal was. But initially you had that US dollar strength on those really good job numbers, but then Jerome Powell came up and spoke, and the concern is going to be, is this too good to be true? Now, just to show you how well the US job market is going, is this is the National Federation of Independent Business survey on labour markets, and what they're saying, according to this data, is that increasingly, you see this orange line here, increasingly firms are having positions which they're not able to fill. Okay. Now, if a firm isn't able to fill a position, the way that it attracts people is by increasing wages, because that's what attracts people to work for the company. And this is going to increase the pressure on earnings for the US. That's an upward pressure for US earnings, which is good news for consumer spending, and it's good news for the economy. So this is a rosy picture for the US economy. But the concern here, and this is again, we need to know the narrative. The concern here is, okay, this is all well and good, okay, but is it too good to be true? Because is this just like is this the last firework, before and then the good news is going to end? That's kind of the way that the sense that the market's feeling. So Powell commented after the jobs data on Friday, okay, and this was the result of the turnaround. Now, I was there at the time, it was 3 o'clock, his speech came out, price just dropped down to this pivot point, and I was waiting to see what he was saying. I'd moved my position short to break even, and then there was a very strong reversal on Powell, and this is what happened. He was saying, okay, most of the hard data remains solid. He said today's data was very strong, referring to the jobs, which we can see. He says the data doesn't raise concerns about inflation. He says yesterday's ISM manufacturing report was below expectations, but it has been extremely high level. So he's sort of, okay, we can accept that. He says he wants to keep an eye on the sharp 1 month drop. Again, China's consumers appear to be slowing down. That's that Apple data that I referred to, that he's referring to. China could continue to expand at solid, good data still is the story. And then finally, it was the last phrase. He said, we will be prepared to adjust policy quickly and flexibly should that be needed. And Powell says Fed listening carefully to markets' risk concerns, and he's prepared to adjust policy quickly. So in other words, that's what's known as a dovish shift. Powell is suddenly saying, I'm recognizing the market's concerns and I'm prepared to adjust policy quickly, which means that now this was taken as a good news for equity markets. They rallied strongly on this, and it was seen as good in that the Fed is listening, and this resulted in US dollar weakness. Okay, so we had the strength, and now we have the US dollar weakness. Yields rose, which, if you're following on Tuesday, you know that rising yields is an indication, that's bond yields, is an indication of rising interest rates. And from there, we saw that big turnaround that took place, and we've still got that turnaround now. We've got the US dollar weakness is remaining. Okay, there's so much to cover, and it's difficult to cover it all, but just wanted to go through some of the risks that are out there in the market. There's multiple risks. There's the global economic slowdown concern. There's the Chinese economic outlook slowdown concern. Then there's the concern that the US economic upturn looks to have run its course. So is that strong US stage coming to an end? That's the way the market's thinking and concerning as to what extent is that. Then we have the Fed is still, well, had been thinking of hiking into an economy that may be turning a corner, but Powell's changed that now, and he's saying we're listening. Okay, you've got the European Eurozone, which is still on a slow growth. We had data out of Germany today, which was good consumer data, but poor factory orders. So a mixed message there, but the general outlook is a slowdown in European growth. And we've got, the list just goes on and on. I'm not going to have time to go through all the different risks that there are to the market, but there's some of the big ones. And of course, the other big one is Brexit. Okay. Now, Brexit is reaching a crunch point. So if you're trading the pound for the next 2 weeks, you need to have your your mind tuned into this. What's happening is British MPs are meeting to debate this week and into next week about the Brexit deal that Theresa May has established. Okay, what Labour are saying, the opposition to Theresa May's Conservative Party, is they're saying, how can we debate when we don't know what the motion next week will be voting on? So in other words, they're saying, what are we actually voting on? We're going to debate, and the debate is due to start on Wednesday, and we're debating about the vote that we're going to have, but what actually are we going to vote about? There is so much uncertainty in the British Parliament exactly how this Brexit negotiations are going to go, and this is what's a couple of tweets that came out today. We also we've got the vote date, to make sure you put this in your calendar, is on the 14th or the 15th of January. But that could change because everything is very fluid with this Brexit arrangement. But at the moment, it's the 14th or 15th of January seems to be the most likely dates for the vote. We have the UK due to leave the EU on the 29th of March 2019. That is the deadline. And that means that if Britain does not arrange or agree a withdrawal process with the EU, it means that the UK will just leave the EU on the 29th of March 2019, and that will be known as a hard Brexit, and it will be a very detrimental short-term reaction on the pound. You'll see strong pound selling in that instance. The European Commission have just restated out this morning that Brexit will not be renegotiated. Okay, so we have like this is from ING, and they've given like the main options that they might have. One is, could the Prime Minister May's deal is approved? Okay, this doesn't look likely. So Theresa May is negotiating a deal that she doesn't look like she's going to be able to actually get through British Parliament. So this is negative sentiment for the pound. Could there be a second referendum? It's possible. And the key to the second referendum is how Theresa May does and how the Labour Party do. Are the Labour Party prepared to come out and back a second referendum publicly? Okay, can they have a no confidence vote in government? Would Labour sort of nail their colours to the mast? That's going to be having to be looked at. There's a Norway-style deal, which some voices have been wanting this to get a different kind of deal than the one Prime Minister May has established. Could there be a snap election? Could there be no deal? So in other words, this is where things are headed to at the moment. Okay, that's that no alternative found before March 29th. That is a real possibility at the moment. So we're going to see a negative sentiment for the pound. Obviously, we're seeing dollar weakness at the moment because of the concerns over Powell and that slight dovish shift from Friday. But the key areas to look at is the 100 exponential moving average and the 200 exponential moving average. You can see how the 200 was respected here, here, here. And the 100 was respected here and here and here. And you have the 50 exponential moving average respected here. So look at these moving averages as sensible places to consider a potential short. Though remember, if you're trading the pound at the moment, it's very, very volatile. So you need to expect volatility, and that is going to be carrying on until this Brexit negotiation is sorted. But remember, if it does get sorted in a good way, remember that the pound is quite undervalued. It's at historic, very low levels against the dollar. You can see, like, going back to, all the way back to 2001, 2008, and you could go back even further if you had other charts. These are really, really historic lows. So that offers a good bargain to buy the pound for a long-term trade. So a long-term trade is, 500, 600, 700 point stops, playing for longer term moves. So they're the ways to play the pound at the moment. If you wanted to try to rally out, ride out the volatility, you'd need a very large stop. You have to adjust your position size as well, and also be aware that there is a real possibility of a no-deal Brexit. So you have to factor that in and make sure that you've sized your position correctly in accordance with that. Again, this is not trading advice, it's just education. I'm trying to give different options, different ways that I'm looking at the market, how a trader might approach it, how you define and limit your loss, how you allow for volatility, adjusting your position size, but also being aware of the wider context. So you can see that there is so much going on. Monday morning, got US dollar weakness across the board. You can see it was weaker against the Swiss franc, the euro, New Zealand, Australian dollar, Japanese yen, British pound, Canadian dollar. Again, the Nikkei closed up 2.44%, proving US-China trade talk rhetoric. That's going to be in focus again, the US-China trade talk. If a good deal gets done there, that's going to really boost confidence and risk sentiment. We've got Powell's dovish stance. China decided to cut their reserve requirement ratio last week by 100 basis points. That's just to help provide some easing for Chinese banks for their loan requirements and their loan provisions. And those base points coming into force January the 15th, January the 25th. That's good for the Chinese economy, and that helped, some of this surge in equities that we have been seeing. Just going over to some of the equities, you can see, from last week, Dow's up 3.29%, with the Nikkei up this morning 2.44%. The S&P 500 futures just approaching flat. They were up 3.43% and 4.26% for Nasdaq on last Friday. So let's go into the week ahead. Okay, we needed to understand the context because you're not going to understand the significance of various events until you understand the context. Everything has to be in its context. So looking at Monday, let's just check I've got the right week. Yeah, I've mentioned that we had the data out of Germany earlier. That's not appearing. Let's just see, what is that this week? Let's see if I can get that up. Consumer Price Index. Let's just check I've got these filters. Oh yeah, there it is. Great. So you can see here, Germany retail sales were up. So that's a good positive force for the Eurozone economy. But the factory orders were down, so a mixed message coming out of Germany. Germany is the Eurozone's largest country, so closely followed as a good indicator what's happening for the Eurozone. We have coming out at 3 o'clock the ISM non-manufacturing PMIs. Now, these are normally released before the NFP data, okay? Now, this is kind of, Powell hinted on Friday that there's a bit of a slowdown in the US economy, okay? So this data is going to be eyed quite carefully today as an indication of where the US economy is heading. I think the Federal Reserve have signaled that they're only looking at 2 rate hikes this year now, as opposed to 3. And then now they're going to be sort of data dependent. So data is going to be factoring in. And I think for today's session, for the US session, this is going to set the tone for today. So I personally am not going to be entering any US dollar positions until this data is out, because this is going to be, this is what the market is essentially waiting for. And you get a strong number here or a weak number here. Weak number here, you're going to see more US dollar weakness. And that would likely to follow over into the Asian session as well. So just check out the ISM non-manufacturing PMI. Normally it's released before the NFP, and it's just a little bit more in significance today in respect of what happened last Friday. On Tuesday, we have Eurozone data out of Germany, industrial production. Again, just keep your eye on what's happening in the Eurozone. The general rhetoric is slowdown in Eurozone growth. So just keep looking at these figures, industrial production, manufacturing out of the larger Eurozone countries. So nothing to trade on, but just to be aware of, to keep your eyes on that. We have Canada and the US are releasing trade figures. Not necessarily anything of particular tradable importance, but just something to be aware of. You've got exports and imports coming out of Canada and a trade balance out of the US. And then on Wednesday, we're getting latest employment figures out of the Eurozone. So we're getting unemployment rate coming from there. And we've also got the Bank of Canada interest rate decision. Now, the Bank of Canada had been raised interest rates back in October, and they made it a hawkish hike, sort of indicating that more interest rates were to come. But then in the December meeting, they said actually the economy can still grow without creating a lot of inflation. So they sort of pedaled back some of that hawkish hike from October. So this is really worth looking at. On Wednesday, come and look at the rate statement. But remember, the rate statement, you've always got to read it in line with the press conference. Okay, so you can just go to the Bank of Canada and you can find the rate statement there on the Bank of Canada website. Just Google that, it's easy to find. And just bear in mind, okay, they were hawkish like October, and from here they backpedaled in December. Now, where are they now? Okay, now obviously they're going to be keeping an eye on what's happening in China and the US as well. So you need to sort of read their statement in light of how they're understanding all those things. Then you've got the FOMC minutes. Now, these are going to be important because, as I said, the Federal Reserve downgraded its projections for 2019 from 3 to 2 hikes. Okay, and so Jerome Powell has said that the Fed is going to listen to markets, and so now markets going to be reading back into those minutes What was the Fed thinking when it when it hiked last time? What was it thinking about just pedaling back those expectations of more rate hikes? So that is going to be influential for the US dollar. So make sure that you are aware of those FOMC minutes, particularly for any dollar positions. You don't want to be in a dollar position that's short term heading into the FOMC minutes. On Thursday, we've got the European Central Bank publishing their minutes. Now, they are giving their minutes. Now, they ended 2018 by ending their quantitative easing program, which is what they expected to do. And Draghi was kind of cautious about 2019. Now, their path at the moment is one rate hike, in the summer of 2019. That's their path. But through the tail end of 2018 and the sort of fourth quarter, the concern was there's a lot of Eurozone slowdown. Okay, so folks are beginning to think, will the ECB slow down their path of rate hikes? There's a distinct possibility they will. These monetary policy meeting minutes will be analysed carefully to see any hints for that. Also, we have Fed's Jerome Powell speaking. Now, so remember, on Wednesday, you've got Powell's the minutes. Okay, so the market's going to react to those minutes, and then on the Thursday, Powell is going to give a speech. But remember, he says, I'm listening to what the market is saying. So he's obviously going to be trying to, tweak his message to guide the market. Say, well, yeah, you're on the right lines or you're on the wrong lines. So make sure that when you read the minutes, you also have to be aware that Jerome Powell, the chair of the Federal Reserve, is speaking at 5 o'clock, and you have these other Fed speakers as well who can also move the market, and there's also opportunity of tweaking or enhancing or amplifying Powell's message, because you can see that they're speaking after him. So that's something to be aware of. And then Friday, we've got some GDP data out of the UK, but again, Brexit is going to be taking centre stage, but the market will not be, as soon as Brexit is sorted, then all the, the fundamentals, will come right back into play. So you've got to look at the GDP. How is the UK economy doing? But remember that the short-term reaction is going to be Brexit, Brexit, and that you can't get through that. So that is. Oh, of course, nearly forgot. The belle of the ball, one of the most important data releases is core inflation that's coming out, expected to be 0.2% on Friday, and we'll get the number for December here. Now, the impact of if this inflation starts to soften, if it starts to weaken, that's going to see more US dollar weakness. But if that, if we get good ISM manufacturing numbers today, we get a slightly, a more optimistic message from Jerome Powell, we get a good core CPI data out of the US, and if you get positive US-China trade talks, then you can see some US dollar strength. So, as I said, we're at a really interesting point in the market here, because the market is trying to understand which narrative do I focus on. Is the US economy slowing down? Most analysts seem to think it is. But how quickly is it slowing down? Is global growth beginning to weigh on the global? Is China's slowdown beginning to weigh down on global growth? Is China's economy slowing? It appears to be. Okay, so the market is just trying to position itself for 2019. We're seeing people bringing a lot of their riskier assets back into US dollars because people are nervous. They're not wanting to have money in emerging markets. They want to have their money in US dollars. Let's wait. Let's see how the market settles, and then we can initiate our positions when we get a settled direction in which way the economy's going. So keep looking at these stories, and if you're looking at how do I begin to apply this information? It's all very well knowing this. It's all very well it's all very well knowing, these different market movements. How do I begin to apply it? Well, that's why HYCM, that's why we offer this 8th of, oh, no, sorry, it's not, it's the leveling up with HYCM. That's why we offer this leveling up. It's tomorrow between 1 and 2 o'clock GMT time, and you come along there and I start to show, not trading advice, but I do get into specifics about how to create for yourself a workable template to interpret this information in a way that you can trade with. Okay, so that's what happens tomorrow at 1 o'clock, 2 o'clock. So if you've enjoyed this webinar, if you've enjoyed coming to that, you've been given an invitation for tomorrow's workshop privately that's come through to you. So if you haven't come to a workshop before, come along, because it may seem complicated at first, but I begin to break it down and I give folks a template which you can use on your own as a guide, as a framework for you to make your own trading decisions. Again, it's not trading advice, it's about how to educate you to find your own trading setups. And it can I say to you, if you've been struggling with trading and perhaps you're finding it's too unpredictable, you're not sure of why your position was stopped out so quickly, why did that data have any move, and maybe you got frustrated, understanding the fundamentals and the technicals together will begin to make it much clearer for you. You will start to see not only which way the market is moving and technically how it's working, but when you understand the fundamentals, you understand why it's moving. Okay, so that's tomorrow, 1 o'clock, 2 o'clock. Do come along, and as an extra incentive, there is a prize draw that's drawn every month for those people who've attended the workshop. You have to attend the workshop live, and you have an opportunity of winning 1 hour's one-to-one personal webinar with myself, where I can really focus in, give you some personal attention, find out exactly what area of your trading it needs help with, where you're struggling, where you're strong, and we can that is a service that's offered as a free 1 hour trading course. Okay, you'll get some information to that which has been messaged to you. Okay, guys, it's good to be back for 2019. It's really good to be with you all and getting stuck back in. And what a market we're seeing. What a time to come back for the new year. And I'm looking forward to seeing how this all works out and pans out. And hopefully I'll see you guys next week, and some of you guys tomorrow as well. Happy 2019. I've really enjoyed being back, and I hope you enjoy the rest of your week. Thanks, guys. Goodbye.